Global ratings agency S&P has upgraded India's sovereign credit rating to BBB with a stable outlook. The credit ratings agency has said that the impacts of higher U.S. tariffs will be, and I quote, manageable. It also expects more fiscal consolidation as it believes growth is on track. Ritu's here with more from S&P. Finally, an upgrade coming in there from S&P. Ritu, take us through the history of how India does and how it compares to Moody's and Fitch when we talk about S&P's outlook.
Well, Shireen, it is a landmark move for India's economic story. S&P upgrading our sovereign credit rating to BBB from BBB- with a stable outlook. Keep in mind, this is India's first rating upgrade by S&P in nearly 18 years, and it signals a stronger vote of confidence in the nation's economic and fiscal trajectory. Now, for perspective, S&P's new rating is the second lowest investment grade rating. It is just one notch above Fitch's BBB- and Moody's equivalent Baa3, both of which again sit at the lowest investment grade level. Now, if you look back at India's rating history, S&P first gave India a rating in 1990, that is before the reforms, and that was at BBB. The 1990s, of course, saw some setbacks. The rating slipped to BBB- in 1991, then again to BB+ the same year, down to BB in 1998. From there, we climbed back all the way to BBB- by 2007, which is where our rating has now stayed until the long-awaited upgrade today. We're essentially, in a sense, Shireen, back to where we were in 1990. Now, S&P says the upgrade reflects a buoyant economic growth, improved inflation control, and a clear commitment to fiscal consolidation. India, it says, has staged a remarkable comeback from the pandemic, clocking an average 8.8% real GDP growth from FY22 to 24, the fastest in Asia Pacific, and it is now projected to grow around 6.8% annually in the next 3 years. Public investment is a key driver. Central government capex spending is set to hit 3.1% of GDP next year, which is more than 50% higher than a decade ago. And at the same time, fiscal deficit is projected to narrow. Debt to GDP could fall from 83% to 78% by 2029. Now, what does it mean in terms of immediate benefits for India? First and foremost, it is going to bring down our cost of borrowing. That is very important for the country. And of course, it will trickle down, the corporates borrowing overseas as well. It boosts the confidence in our long-term growth story because, this is a long overdue acknowledgement of India's stable macroeconomic fundamentals, whether you look at GDP growth or you look at the fiscal consolidation and even the inflation control. And now we have to see if other rating agencies will follow suit.
Yes, that is the big question. Will the others follow suit? Ritu, thanks very much for joining us and to take this conversation